In my today's video, I'm going to address two fundamental questions. One, what is accounting? And two, who needs it? Most of the people dread the concept of accounting. My today's objective is to make these concepts a little easier and understandable for beginners. And I hope you enjoy this video. Accounting is all about information. Therefore, it is also called information science or information system. Basic purpose of accounting is to provide decision makers with information useful in making economic decisions. These decisions concern the allocation and use of scarce economic resources such as money, land, and labor. The manner in which we allocate and use economic resources shapes the world's economies. Information produced by an accounting system can be both financial and non-financial. Historically, accounting was understood to be an information science dealing with only financial information, but in recent times, non-financial information has become equally important in decision making. Accounting has often been called the language of business because it is the backbone of all businesses in decision making. We call it a foreign language. If you travel to a country where your native language is not spoken, what will happen? You will have a problem in effectively communicating with the people in that country. Similarly, accounting is a foreign language which everyone will have to learn to understand financial results of any company. How is all this information produced by an accounting system? Accounting systematically records, analyzes, and reports important financial information. It communicates the financial health of the business to all the interested parties we call users or stakeholders of accounting information. Let us talk in some detail about all the keywords we just used in relation to accounting process. Record. For any information to be produced, basic data needs to be recorded. Accounting records all the necessary data about its sales, purchases, employees, assets, liabilities, and loans in a systematic manner. Accounting data or business transactions can be recorded manually, but use of computer systems called ERP are widely used nowadays in recording accounting data. This part of accounting process is called bookkeeping. Analyze. Once you have recorded the data in your system, you need to classify and process that data in a meaningful way to produce analytical reports or dashboards for day-to-day decision making. This kind of analysis and dashboards help managers to take corrective actions and plan things in a timely fashion. Report. Accounting produces reports both for external and internal users or stakeholders. Reports for external users normally falls within the scope of financial accounting and typically includes income statement, balance sheet, and cash flow statement. These reports are produced for statutory purposes also, depending upon the regulatory jurisdiction in which a business or a company is operating. Reports produced for internal users such as managers, the board, or other interested parties falls within the scope of managerial or cost accounting. Let us talk now in some detail about the main reports produced by accounting system. Income statement. Income statement is also called profit and loss or P&L. It shows income, expenses, and profitability. Profit or loss is arrived at by deducting expenses from income. Let us look at a practical example of how income statement works. Vicky is a college student, but nowadays is enjoying his summer holidays. He thought to make some bucks during his summer holidays. It's a hot summer day and people like to go to parks in the evening. Vicky thought to buy some soda cans from a supermarket and sell to people at the park for a profit. He buys 100 cans of soda at the rate of $1 each, which means he spends $100. He sells these soda cans to the visitors at the park for $1.5 each. By the nightfall, he sells all 100 cans, grabbing total cash of $150. This means the cans cost him $100, which we call cost of goods sold or cost of goods purchased, but he made a sale of $150, which gave him a net income of $50. Balance sheet provides a snapshot of what a business owned on a particular date as assets, how much business owed to its owners called equity or capital, and how much it owed to other parties, internal or external, called liabilities. In other words, it is called financial position of a business on a particular date. As the name signifies, the balance sheet has to be balanced, meaning both left and right sides should be equal. Let us draw the balance sheet in T account format. On the left side, we show assets, and on the right side, we show liabilities and equity. What are assets? Assets are the resources or things a business owns and uses in the business. Assets include land, building, office furniture, cash, to name a few. Liabilities are what you owe to others, such as accounts payable, bank loans, etc. Equity is little more difficult to explain. Let us explain it in this way. If a business sells all its assets today and settles or pays off all its liabilities, the money left over will belong to owners, which is called equity. In other words, equity equals total assets minus total liabilities. Let us illustrate how a balance sheet works practically. Considering the example of Vicky, he invested $100 in business, which created two entries in his balance sheet. On the one hand, his cash asset was created. On the other hand, it created equity or capital for him. So he used that cash to buy stock or inventory of soda cans for $100, which means his cash asset decreased and another asset called inventory was created. So his overall asset position did not change. When he sold all his stock or inventory, he grabbed a total cash of $150, which again raised his cash asset to $150, and his inventory decreased as a result of sales he made. The profit that he made increased his retained earnings or net income by $50, which resulted in an overall increase of $50 in the balance sheet. So, in a nutshell, if a business makes a profit, owner's equity goes up, and if it makes losses, owner equity goes down. Cash flow statement. Cash flow statement summarizes the amount of cash and cash equivalents entering and leaving a company. It measures how well a company manages its cash position, meaning how well the company generates cash. Typically, a cash flow statement has three clear sections, namely cash from operating activities, cash from investing activities, and cash from financing activities. We have covered the first 3 points. Let us now talk about communication. Communication. This communication part of the accounting process answer the question, who needs accounting? The question now is, why we produced this information in the first place? It is of no use if not communicated to interested parties. So accounting process, therefore, communicates this information to a variety of stakeholders. For example, shareholders or owners, employees, bankers, managers, government or tax authorities, suppliers, customers, and society. It is very clear from this presentation that some of these stakeholders can be classified as internal stakeholders and some as external stakeholders. Having looked at the overall accounting process, we are now in the position to look at the proper definition of accounting. Accounting can be defined as the art of interpreting, measuring, and communicating the result of economic activities. Our accounting system should be capable of dealing with requirements of the economic environment it serves. Redebar, Gray, and Sydney beautifully summed it up as accounting systems evolve, reflect, and reinforce the economic environment they serve. Thank you for watching this video. If you liked it, please subscribe my channel.